Is the world economy about to hit the brakes in 2026 and slow down like never before? Global growth forecasts are shifting. Economists are debating whether a slump is looming, and investors are scrambling to interpret the data. This video dives into the most recent forecasts, the biggest economic headwinds from inflation to trade tensions, and what it really means for your money and markets. This breakdown explores what the IMF says, what the biggest headwinds are, and what it all means for investors watching this fragile landscape. Understanding what's coming could shape investment decisions and even impact jobs, savings, and futures. Stay until the end. The real answer isn't what most people think. The latest IMF World Economic Outlook paints a picture of an economy that's still moving forward, but with far dimmer prospects than just a year ago. Growth forecasts are drifting lower, inflation tensions remain, and global trade is fragmenting in ways that could reshape everything from supply chains to stock markets. The question everyone wants answered is simple. What does the IMF actually expect for 2026? According to the October 2025 World Economic Outlook, global growth is expected to slow from 3.3% in 2024 to 3.2% in 2025, and then down to 3.1% in 2026. The IMF describes this as a world of dim prospects. Not a crisis, not a collapse, but a quiet weakening of the global engine. It may not sound dramatic, but even small slowdowns hit hard when economies are already stretched. Consumer confidence is soft, business investment is slowing, policy uncertainty is rising, and trade tensions are becoming structural instead of temporary. The IMF isn't predicting a recession. It's predicting something more subtle, a world losing momentum exactly when it needs it the most. One of the biggest forces behind the slowdown is global trade tension. The IMF highlights that U.S. tariff levels rose to heights not seen in a century, triggering a wave of supply chain rerouting, higher policy uncertainty, and delayed investment decisions. Even though some tariffs were later adjusted downward, the IMF warns that trade policy uncertainty remains elevated. And uncertainty is toxic for growth. When companies don't know where trade rules are heading, they hold back on spending. When exporters face sudden market barriers, production slows. When supply chains get rerouted, costs rise. And most importantly, confidence drops. And once confidence drops, growth follows. Another pressure point is inflation and interest rates. Inflation is cooling globally, but not fast enough. The IMF expects global inflation to fall to 4.2% in 2025 and 3.7% in 2026, but warns that price pressures in advanced economies, especially the United States, are proving stubborn. High interest rates may no longer be rising, but they're still elevated, and their effects echo long after the hikes stop. Borrowing remains expensive. Business capital spending is slowing. Housing markets are softening. Banks are tightening credit. All of this adds friction to economic momentum. The IMF cautions that inflation could stay sticky, forcing central banks to remain cautious and slowing growth even further. Now the numbers alone don't tell the full story. One of the biggest emerging risks? Trade tensions. Tariffs and trade barriers have been rising between major economies, and that stunts the most powerful engine of growth, global trade. According to multiple reports, protectionist policies continue to cloud the outlook and could shave even more growth off forecasts if they intensify. Why does this matter? Trade fuels investment, builds supply chains, and lowers costs for consumers. When trade slows down, investment dries up, companies delay hiring, and confidence drops. And here's the real impact. Investors tend to pull capital back the moment uncertainty rises. Markets hate uncertainty. When investors pull back, growth slows even more, not just in exports, but in factories, tech spending, and jobs. Trade tensions aren't just political noise. They're a real threat to growth. But a deeper issue sits beneath all of this. Investment is not recovering the way the world needs it to. The IMF describes weak investment as one of the most troubling signs heading into 2026. Even with strong profits, companies are holding back. Higher financing costs, weaker demand expectations, and global uncertainty are leading firms to delay or cancel long-term projects. Investment is the fuel for future productivity, new factories, new technologies, new infrastructure. Without it, economies lose the ability to grow faster in the future. And right now, according to the IMF, investment momentum is far too weak to support a strong global recovery. Some analysts hope emerging markets will offset the slowdown, but the IMF says that optimism may be overstated. Yes, emerging markets are still projected to grow just above 4%, but several challenges are building. China's slowdown continues, with exports weakening and the property market still fragile. The IMF warns that China is on the verge of a debt deflation cycle. Many developing economies face shrinking fiscal space, rising borrowing costs, and weaker external financing. Low-income countries are being hit hard by cuts in international aid. Commodity-dependent economies face unpredictable price swings. Emerging markets can still support global growth, but they can't carry the entire world the way they once did. The IMF also outlines several major risks that could push growth even lower than 3.1%. Prolonged policy uncertainty could keep holding back investment. Further protectionist measures could disrupt supply chains and lower productivity. Labor shortages driven by aging populations and tighter immigration policies could weaken output in advanced economies. High debt levels paired with rising borrowing costs could expose financial vulnerabilities. The IMF also highlights the possibility that the ongoing AI investment boom could mirror the dot-com era rapid growth, followed by a sharp repricing if earnings disappoint. And climate or geopolitical shocks could trigger commodity price spikes that pressure inflation again. What happens when governments run out of room to protect their economies? Around the world, countries are entering 2026 with far less fiscal breathing room than they had even a few years ago. The IMF warns that public finances in many major economies are becoming dangerously stretched. Years of emergency spending, weak revenue growth, and higher interest rates have pushed debt levels to the highest range seen in decades. The cost of servicing that debt is now rising fast. Countries that once borrowed cheaply are now spending a growing share of their budgets just paying interest. Every extra dollar spent on debt service is a dollar not spent on investment, infrastructure, innovation, or social safety nets. What happens if a crisis hits when governments can no longer afford to respond? The IMF says this shrinking fiscal space is one of the most serious vulnerabilities heading into 2026. If growth slows further, or if another shock hits, many governments may not have the capacity to cushion households, stabilize markets, or support struggling industries. And the most fragile countries feel this even more. Low-income economies face rising borrowing costs, falling access to global capital, and sharp cuts in international aid. For many, a single commodity shock or a short period of financial stress could push them dangerously close to a debt crisis. While governments feel squeezed, markets are acting like they're in a boom. Much of that optimism comes from one force: artificial intelligence. The IMF compares today's AI surge to the dot-com boom. Money is pouring into data centers, cloud infrastructure, chips, and automation tools. AI-linked investment has become one of the strongest contributors to global growth, even as other sectors cool. What if the AI story is moving faster than the real-world payoff? The IMF warns that if profits fail to match the excitement, markets could face a sharp repricing. If this breakdown helped you understand where global growth may be heading, hit the like button so more people can see it. Subscribe for more deep dives into economic trends shaping the world.